Well, hello everybody. This is Dave Berkus for the Berkus Report for Eye on Business. Today we're going to speak of the changes in early investment and the way in which the investors have moved upstage and downstage to be able to make quite a different ecosystem than we used to see in the past. So let's look at the traditional food chain as we used to know it back in the day when it was very typical in the way in which people invested. First of all, we began with friends and family, and that allowed people who are either your own family or yourself with your own credit cards or whatever credits you could find to begin a business without having to have outside people appraise or value the investment as it began. And then we moved upstage. The angels, typically in angel groups, sometimes individuals, would invest in a company, giving it a value for the first time and taking a piece of the business, typically between 15 and 25% of the business for having done so. And then the angels, as they developed the business and it became more successful, would bring it into the venture capital arena. And the venture capitalists would take over and invest anywhere from $1 million to $5 million typically for funds that were typically between $70 million and $100 million in size. That was fine when the venture capitalists wanted to take a board seat for one of these companies when it made an early investment. The problem was the venture capitalists raised larger and larger and larger funds. And when that happened, the industry changed very quickly. So now it looks a little bit different than it did before. Here's the new capital food chain, for example. Those friends and family investments, they're still there. But look at what's happened. First of all, now a company, even at the idea stage, can get into an accelerator or an acceleration process. Accelerators are groups that have become very popular during this last decade, even though there are fewer of them today than there were 2 or 3 years ago. An accelerator will take an early stage company and move it through a typically 3-month process in which the accelerator adds value by teaching the entrepreneurs many of the elements of the business, helping to perfect the plan, to perfect the product, and the rollout or marketing and the service of the product itself. The accelerator will add value, and typically a company coming out of an accelerator will ask for a valuation higher than had it not gone through the accelerator. Often this is a good thing, often it is a bad thing, because now your investor will be asked to pay more money for the company just because it has gone through acceleration. Now look at the angel networks. These are groups of angels who have banded together in groups of 30 to, in some cases, 300, where individuals of high net worth will make a single investment or invest as individuals after having a presentation by the company. Often these groups are good for about $400,000 to $500,000 worth of initial investment, but they do learn how to syndicate, where groups get together and decide more than one group can make an investment in the company, and often those investments now rise to $1 or $1.5 million. And in fact, I have one example where $6 million was raised for an initial early stage company based upon syndication of these angel groups themselves. You'll see in the chart, acquihires. That's a term that is used when a company buys an early stage company just for the people who are either the engineers and developers or the people who are the marketeers. But to get the people may be cheaper by buying a company than by just trying to find the right hires and hoping that they are good. Notice at the bottom of the chart, crowdfunding. This is rather new, and there are 2 forms of crowdfunding, and we ought to explain them both. The first, an Indiegogo or other form of posting, allows people to pre-purchase your product so that money is given to you early enough that you can actually produce the product. And then those people get a discount, of course, from the product having been bought earlier on. But the other form of crowdfunding, which came recently when the SEC finally approved it, is an early form of being able to invest in a company when you would not have been able to otherwise. Let me explain. Accredited investors have been able to invest in companies of any size because they can bear the risk. Accredited investors at this time are investors that either have $1 million in net worth or $200,000 in income per year, and therefore the SEC believes can accept the risk. The new rules for crowdfunding allow there to be platforms on the internet which can accumulate people who have less than that value of net worth and allow them to invest in these early stage companies legally. So now, if you have either 10% of your net worth or a maximum of $10,000, you're able to invest in one or more of these companies at a very early stage using one of these platforms. If you'll look at the angel funds that are shown on this chart as well, now there are, because they have been developed often by the angel networks, a large group of funds which will have a single investment into your company, but the fund itself is composed of anywhere from 10 to 60 or 70 or more angels that have gotten together and pre-valued these funds to allow them to invest as one. And then you're going to see, as you get through this same chart that has changed over time, super angels. Super angels are individuals typically who have made quite a bit of wealth, having taken their stock options or earnings from the sale of their companies and now investing it in new young companies as well. And then finally, those VCs that we saw on the first chart have moved upstream to the point where they have much larger funds typically than they had before and typically invest much larger amounts. But that allows them to invest the larger amounts because all of these other new methods of getting money to the companies to help them grow have inserted themselves in between what used to be a very simple network of just friends and family, angels, and VCs. Well, I hope this has helped you to understand the differences that have happened over the years and given you a better idea of where these companies have come from and where these companies are going in finding their financing. This is Dave Berkus for the Berkus Report for Eye on Business. See you next time.